Welcome to the Remarkable Retail Podcast, our 300th episode. I'm Michael LeBlanc.
And I'm Steve Dennis.
We are celebrating our 300th episode of the little COVID project that grew with one of the most respected voices in retail, Pete Nordstrom, Co-Chief Executive Officer, Nordstrom. Celebrating their 125th anniversary, Pete shares key milestones for the business, what animates the Nordstrom team to deliver retail excellence, and the future prospects for the department store sector and beyond. Now, first, we'll be covering top retail news of the week, including sharing some tea, as the kids would say, on macroeconomic outlook, earnings from Amazon, Starbucks, and Wayfair. And then after our interview with Pete Nordstrom, we'll get back with more news about TikTok and the UK resale platform Vinted. And then what's on our respective radar screen. So, Steve, 300 episodes. Yeah. Congratulations to you. That's a pretty important milestone, I think, right?
Well, yeah, it's been quite a journey. I don't know whether to credit you or blame you for getting me into this thing. But yeah, I've mentioned to a few people that we're coming up on our 300th episode, and most of them are quite amazed by that. And so I take that as a compliment, because doing this just about every week for 5.5 years takes a lot of focus and resilience. So I appreciate all that you do.
All right, well, let's jump into the news of the week. There's plenty of it.
Well, this past week really has been a lot of macroeconomic news, which I thought I would just touch on briefly and probably steer clear of too much commentary about the war, given how volatile the situation is. But I do want to mention, I don't know if you saw this or not, apparently Wall Street has gone from talking about the taco trade, the Trump always chickens out trade, to the nacho trade, which is...
Oh, I heard that.
The nacho trade is not a chance Hormuz opens. But the macroeconomic news, well, first of all, obviously, I'm sure everybody is aware, wherever you are, it seems gas continues to rise. Some U.S.-specific stuff, and then I'll talk a little bit about Europe, and maybe you can chime in on Canada. But there was a Gallup survey last week that showed that 55% of Americans believe their financial situation is getting worse. That is the highest ever in the survey's history, including surpassing COVID times, which I think as a frame of reference is kind of interesting. Also, the U.S. federal deficit will be at 100% of GDP, hasn't been there since World War II. So those are some ominous signs. But probably the bigger news, which I'm sure many people saw, was that the Federal Reserve kept interest rates steady and they raised their inflation outlook. But again, as we've touched on just about every episode, probably since the war started, or maybe even longer, really since the tariffs, is we've got this dichotomy between consumer confidence and things that would seem to suggest a big slowdown, and yet spending continues. Now, on the European front, where things, frankly, across most of Europe seem to be a lot less rosy, the ECB kept rates steady as well. They suggested that rate increases might be on the horizon because of inflation worries. At the same time, they shared, Christine Lagarde and others from the ECB shared that they see GDP close to zero throughout most of Europe. And I think one thing that, we've touched on a little bit, I don't think we've come back to it for a while, but part of what's going on in the US that's driving GDP, in fact, most of GDP, is the AI investments. You don't have nearly...
Mag 7, the Mag 7 as they're known, right?
Right. And so, a lot of that, not all of it certainly, but a lot of that is centered in the US. So you don't have nearly the AI boom. You have, usage clearly in Europe, but you don't have so many of the data centers of the companies being located.
Company's not based there,
There. Yep. So anyway, but once again, Wall Street seems to shrug off any of this negative news because either they're crazy or, the specific reason that's cited is that earnings, broadly speaking, we'll talk about some retail earnings specifically, but broadly speaking, the earnings that have come in over the last couple weeks, 2-3 weeks now, have been pretty positive. Again, mostly centered in the Mag 7 tech kind of stocks. In fact, pretty amazing, the growth there. We're not going to go into that in any detail other than kind of as a sidelight to Amazon's, but really interesting picture. There's a little bit of sense. I'll come back to another story towards the end, which gets into this a little bit more. But, there's almost this sense that like we're kind of at a tipping point at the edge that we haven't quite seen, or, it's being seen more in Europe, maybe not quite as much in the U.S. But again, time will tell. And then I guess, I think Bank of Canada held their interest rates steady, I think, last week.
Yeah, we held the interest rate steady. It's interesting. Of course, here I'm at this food show, and it's a tale of two cities, so to speak. On the one hand, we being Canada, launched the Sovereign Wealth Fund. The oil and gas revenues are skyrocketing.
Right.
Yay, Iran war.
Yeah.
And the knock-on effects that are negative haven't happened yet. Other than, gas has gone up a little bit, not as much. It's already fairly high relative to other countries, but... the cost of food we're now projecting is going to be towards the 6% inflation. Well, that's to come. That's not happening yet. So right now, in a weird way, all we're seeing, in Alberta, the price of crude that we export to the U.S., for example, or your biggest oil partner. If anybody didn't know that, you get more oil from Canada than anywhere else. The price per barrel is good news for our economy and the deficit, but the hits are yet to come, and they're coming, but they're going to come in the fall. So maybe that's this disconnect between how people are feeling and seeing and spending.
Right.
They're a little more money in the gas tank.
Sure.
But otherwise, we're all in line about, just like in Texas. There's some upsides to $100, $125 barrel oil.
Yep.
But there's some longer term downsides yet to see. Let's get into earnings. So let's talk about Amazon. Always an interesting story. The story seems to be, at least the narrative I saw at the top line, was more about their AWS and their cloud versus their retail, but unpack it a little bit for the people.
I mean, yes, relatively, but their stores business, as they call it, was quite strong. So just to touch on AWS, yes, fastest growth in 15 quarters. They definitely called out that that's being propelled by AI. They're making a huge amount of investment in AI, which has really hit their free cash flow. But AWS up 28%. On an already huge base, so that's pretty
big business,
staggering.
Already.
Yeah, the ads business, which, as many people would know, we certainly have talked about, is arguably the most profitable part of Amazon right now, but very much tied to the retail business, was up 22%. Again, they are by far the biggest retail media network, and so that's a huge base with really strong growth. They also pointed out that AI has really been an accelerant there as well, both on the effectiveness and the efficiency side. Getting more to the retail part of the world, their stores business, another great growth, low single-digit growth, really across first-party, third-party, not their physical stores so much, but that's a small part of their base. Units grew 15% year over year. That is the highest increase since the tail end of the COVID lockdowns. That's a pretty staggering number. And I guess, again, one of the things, just stepping back, and actually Andy Jassy talked about this in the earnings call, is how, it's definitely patting themselves on the back, but it's very valid, how impressive it is to grow across all these segments on such a massive base.
A big business. Right.
Yeah, the law of large numbers seems to have been suspended in Seattle. Yeah. But of course, something we've been interested in is they did talk about the growth that they are seeing in the grocery part of retail. We mentioned previously, they already said that they are now the second largest grocer. He talked about that, but it's the perishable grocery sales, they're fresh, that's really growing. Now, it's a very small base, or relatively small base, but it's 40x what it was a year ago. 40. Yeah.
Wow.
And
they closed 30 stores.
Correct.
Just to remind the listeners.
Yes.
Right.
And they have mentioned this, I think, last quarter as well. It is still the case that 9 of the 10 most ordered items for same-day delivery across all of Amazon are perishable products where they're available. So that really seems, it's a little hard to know exactly what those numbers are because they don't call them out. And as I say, the fresh part is on a relatively small base, but that is clearly becoming a big contributor. And obviously they continue to invest heavily in shortening convenience, or shortening delivery time and making things more convenient. I guess a couple things I'll point out really quickly, which I found really interesting. They said that the average price of products shipped decreased. Decreased.
In an inflation.
In an inflationary environment. Now, there wasn't much commentary about how much of this is mix, how much, can they afford to do this? Because basically the ads business is subsidizing. I mean, one way of looking at it is they're making so much money from ads, maybe growing by really being extra sharp on pricing is a interesting strategic move. I would not have guessed that.
Just on that pricing thing, when, my personal experience as a shopper here in Canada or wherever, I don't find them the sharpest price. Or if they're better on price, they're a few pennies. Like they're not dramatically better on price. So I think something else is going on, I guess is my point. It's interesting their units go up, but it's not like they're like 20% cheaper on the like-for-like product. Like it's a penny here, a penny there, and not always cheaper,
Yeah. I think to a certain degree, people probably assume that Amazon's got a really sharp price and they're not necessarily comparing, and it's the convenience or being part of that just locked into the Prime flywheel kind of thing. But I don't know.
Totally.
I guess last two things quickly. They talked a fair amount about Rufus, their proprietary AI agent, usage going up. Dramatic numbers again, relatively small base, so it's a little bit hard to totally parse that out, but obviously a lot of momentum there. And they had record operating margins, so great sales growth, great profit growth, and I think this just feeds in. I mean, we'll see when we hear from Walmart, Costco, a few others, but just continues to feed into this great concentration narrative of so much incremental sales and profits coming from these super scalers.
So as you know, or as I said, I'm on the road today, and actually when I'm on the road is only the time I enjoy Starbucks, because at home I got my own nice coffee machine. So it's interesting. I experience it periodically, and it feels like an improvement to me. Like we're also seeing some improvement, and I guess could we declare that they're getting traction in their turnaround? Yeah,
I think there's some obvious evidence of this. I also experienced some changes at store level, and we talked a week or two ago about how they're trying to reclaim or go back to, I guess, the third place sort of environment that's happening at various places. And so more to come on that for sure. But their comp store sales were up 6.2%. One of the things I thought, the coffee prices have gone up a lot. Maybe a lot of that is inflation, but they pointed out that nearly 4% of that growth was they experienced a 4% growth in transactions. So yes, a little bit of average unit retail, but not out of line with what we might expect. So they seem to be getting better traffic, better conversion. So that's encouraging. They also reported that they were able to increase their product margins a little bit. They also, interestingly, I mean, it's not a huge number in the scheme of things because they have so many stores, but they did have a decrease in their net store count, opening a few stores, but closing a decent number as well. As where I think they're trying to get more focus and kind of pull back on the ubiquity and just, I mean, they're obviously a mass business in many, many respects, but maybe trying to get a little bit more towards that specialty side. So some definite signs at this point of some traction.
Let's talk about Wayfair. So we've talked about them every time they put out results, and it's a business that keeps on ticking and growing in some ways, and somewhat counter growth to, guys, I talked to a lot of the furniture retailers who aren't in good straits with people, not a lot of housing starts and not a lot of people moving around. What did we learn from their results?
Well, a couple of things, reason I want to talk about this. One is just because of the way the home furnishings business has been, and as you pointed out, I mean, and I'll talk about the numbers a little bit more in a second, but they have been growing relative market share, so positive sales in a category that's basically been flat to down. And so that's been their story for a while, and we've seen that with Williams-Sonoma and RH. So I think what's going on broadly in the home furnishings business is there's a lot of contraction. There's smaller players that are falling out, some consolidation. Yeah. So some of the leaders that have the capacity are really kind of pushing to take market share. In Wayfair's case, they're not profitable. So we'll talk about that. But yeah, we've talked about them a bunch. I wrote to. I've been highly, highly skeptical of their business model for a long time. I went back, I looked at two of my Forbes pieces, one I wrote in 2019 and 2022, saying, I don't know that this business model really works. To the extent you care about stock price, since I wrote those pieces, stock price has been down a lot. So this is another one of these disruptor brands, even though they've been around for 24 years now. So they were Pets, much more Pets.com era than Warby Parker era. So it's pretty staggering how much money. I think their accumulated losses are $4.5 billion or something like that. Wall Street didn't like this report very much either. But just to hit the numbers real quickly, 7.4% revenue growth and active customer growth was up as well. So gaining market share, forward momentum, picking up consumers. But they lost in the last quarter $105 million. That is a little bit better because they lost $113 million same period last time. Pretty much what they seem to be doing is slowing the rate of growth in SG&A relative to sales. And a big part of that has been cutting back on their advertising expense. And that was a part where they've been sort of drunk and disorderly, and they've been getting it back. And I assume they've been fine-tuning it, so they're getting more efficiency.
Tweaking.
But they have lost money. I went and checked, thanks Claude.ai. They have lost money every year since their founding in 2002, except for 2020 when there was the COVID crazy spending on home furnishings and shift online. Now, the thing I think that to look forward to and see if this really changes their prospects is, as we've highlighted, they have one large format store open in Chicago. It's been open about 2 years now. They just opened their second store in Atlanta, and they have 3 more on the way, which will open over, I think, like the next 14, 15 months or something like that. Their CFO talked about how excited they are with the results from Chicago and the early results in Atlanta. And something like 50% of the sales in Chicago come from new customers. So being with their size, $11 billion business, to be able to acquire customers in those numbers, I think really says the physical store solves some gaps that keep customers from buying online. Can they continue to grow, make progress on not having so much cash go out the door? Of course, as they open physical stores, they're putting cash investment in it. And one of the things about these online-only businesses, particularly the more marketplace models like Wayfair, is they don't have a lot of capital in the business because they have very little inventory typically. But when you have a physical store, it's a different dimension. So when you have several $100 million in cash flow going out to fund your losses, and now you're starting to invest in physical stores, you would be, better be able to shrink the loss from the online part and get a pretty fast payback, I would think, on those physical stores. So more to come.
All right. Well, that's a wrap on this part of the news. We'll be back with a bit more news on TikTok and what's on our respective radar screens. But now let's get to our interview with Pete Nordstrom. Now, I think you met the Nordstroms back in your role at Neiman Marcus. I mean, you breathed the rarefied air of luxury retail for many, many years. Any thoughts before we get to the interview with Pete? He was very generous with his time and his insights. For sure. I thought it was a great interview.
Over the years, they've featured some of my stuff in their investor presentations, which has been really, really nice. But I mean, I guess what I would say, and we'll let people hear what Pete has to say. But I've really admired Nordstrom as a company for a really long time. They're definitely on my short list of retailers, both that I spend my money at, but also that I have pointed to over the years as a really impressive company. And a lot of that is the way they run the business, not just the nature. I mean, because obviously the department store space has been challenged. One of the things they did is innovate and invest in the off-price segment to help propel their growth, as it became, I think, increasingly obvious that department store is not going to be a growth business per se. It can be a very successful business, and I think it is pretty successful for them. They were also, when I got to Neiman Marcus, and part of my responsibilities were for multi-channel, Nordstrom's was one of the companies we looked at. We talk about this a little bit in the interview, but they were very early on in really integrating, kind of being channel agnostic. And I think that speaks to, every retailer pretty much talks about being customer-centric. I would say very few people really do it. And I would put Nordstrom on the list of people who, walk the talk, so to speak. Yeah. And I guess maybe the last thing I just say quickly is, they've really evolved their business pretty significantly. They've done a lot of experimentation with formats like local. They have partnered with some of these evolving brands and really experimented quite a lot with their format. And they do it without a lot of hype. I don't think they've ever named, this big new transformation thing that they named or put a lot of hype behind it, where they basically tell us that they're going to do a lot of things that, every retailer does. So I appreciate the humility, I guess, is maybe the best way of saying it, and let their actions speak for them much more than press releases and fancy presentations.
And let the experience of the customer speak for itself, right? I mean, that's where the vast majority of people, since we're not a public company, we don't see day-to-day results. I think it's how people feel in the store, and they can experience it firsthand. So,
right,
one of the benefits, or online, depending on how they interact. All right, well, let's get to our interview with Pete Nordstrom.
Well, Pete Nordstrom, welcome to the Remarkable Retail Podcast. We're really glad to have you. Are we getting you from your Seattle office today?
Yes, you are. In beautiful Seattle, where spring has kind of arrived here in the last week.
Well, just about every time I've been in Seattle, it has been sunny, not rainy, contrary to what people say about it, which I think is just a conspiracy to keep people from outside of the state from wanting to move there. But anyway, we're really excited to have you on the podcast for all sorts of reasons. I don't know if you would remember, we did briefly meet many, many years ago when I was at Neiman Marcus, and your store was opening in the La Cantera Mall outside of San Antonio.
Wow.
In the Neiman Marcus store. And you and the rest of all of your family, but some of your family and executives came down to visit our store just before we were opening, and then we all walked down to your store. So anyway, that is a blast from the past, but a lot has happened since then, which is what we want to talk to you about. But I just wanted to start with, I guess, a little bit of human interest. You have spent pretty much your entire career, I think I read or heard someplace that you started as a 12-year-old in the company way back when, but it is the company that your great-grandfather founded. Being part of that legacy, do you see that as a blessing or a burden or something else entirely?
Oh, man, it's total blessing. I mean, there's been nothing burdensome about it at all, as far as I'm concerned. It's been great. There's never an obligation for us to be in the business, the family, or some sense of entitlement that once you're here, you had big jobs. So it all happened in a rather organic way, which might be hard for people to believe. But I have far more relatives that don't work here than do. And that was all, self-selection. And it's worked out great. And
you've had, I think, just about every job in the company. Is that right? I don't want to go too much back through the history, but you definitely just didn't ascend to the senior levels by virtue of your name. You had, I think, it sounded like dozens of jobs based upon what I read.
Yeah, I mean, I was told by one of my bosses that the most meritorious feature I had going for me was my name. But yeah, by and large, I touched a lot of bases, did a lot of things. You mentioned I started when I was 12. I mean, I worked some days during the summer in the stockroom. That stuff happened, I was 12, 13, 14, 15. My parents made it pretty clear that if I wanted money to do things, that I had to earn it, which was great. Looking at the time, I didn't love that, but looking back on it, that was probably a really good thing. And I started selling shoes when I was 16. That was during the summer, and that was just really a means to an end. I wanted to be able to buy a car. And, my parents weren't giving me a car. So that's how that all went. It wasn't about some grand plan about learning everything through the company. It was just, I'm a 16-year-old that needs a job so I can buy some kind of car that's going to work. And then I kept doing it during the summers. And I really didn't know that that's what I was going to end up doing probably until I was, 21 or so years old, before I'd graduate from college. And I just decided, let's do it. And I understood what the opportunity was. I clearly could see, from having spent the time there during the summers and my dad and my relatives. And that all seemed really positive to me. It didn't seem like a negative thing. And my brothers were in a similar boat. And I really liked the idea of actually working with my brothers. I wasn't trying to get away from them. So that's how it all started. And really, but once I got going, post college, and I didn't wait around, and there was no gap year or any of that kind of stuff. I started right away. And I just decided to take whatever opportunity given to me that was different, bigger, whatever, just in pursuit of, finding my way and learning things and being able to be in a position where I could have bigger jobs. And I had them all. I mean, assistant manager, department manager. I was a buyer. I was a merchandise manager. I was a store manager. I was a regional manager. So I came up really through all the commercial parts of the business. When you said I've had every job in the company, I mean, one thing that's become clear to me over time, it's a big company with a lot of different things going on. And, there's so many different functions here that I've never done those jobs. And so I have a deep appreciation for all the different skills and talents and people it takes to be able to make this whole enterprise work.
So it's a 125-year anniversary. That's a huge milestone for any company. It's becoming a smaller and smaller retail club. As you reflect on that remarkable milestone, what's been the key to that longevity? It feels very much like, I'm reflecting on what you were just saying about growing up in the business. That seems like a culture that's imbued that is very helpful. But what's your perspective? I guess a different way to ask it, how have you lasted 125 years in such a competitive place?
Well, I think a big part of the culture is an inherent focus on the customer. And when you do that, that allows you to evolve naturally because customers evolve and change. So once you figure out that customers determine what good service looks like, and really the only reason we're here is to serve customers well, they have choices. So as a result of that, that is just a built-in mechanism, I think, for the evolution that we need to stay relevant. That's the kind of stuff we talk about all the time. If you think about in my generation, the whole game completely changed. My dad's generation, there were stores, there were wholesalers. You bought stuff from wholesalers. You offered it to customers in a store, and that's where they bought it. There was no other way of doing it. And that play was run for decades and generations. But then when our generation came along, all of a sudden, the internet was part of it. Even things like brands, they weren't all wholesalers. They were actually going direct to customer too. They had their own stores. They could sell to customers as well. And so we weren't as necessary, I think, in that ecosystem. And we had to figure out how to earn our place. And I think there's been a lot of carnage along the way, as if you kind of mentioned. But I guess the credit I would give us is that however it happened, there's a culture here about evolving, the humility about what this job is, and making sure that you're willing to change and evolve. And that's helped us.
One of the things I was very interested in when I got to Neiman Marcus in 2004 or so, if I have my timing right, is Nordstrom was one of the first companies, I think, to really get serious. I guess, we call it omnichannel now, but you seem to really make the decision to be basically channel agnostic and have a centralized inventory system and a lot of things that, frankly, it seems like some companies still struggle with today. I'm just curious how that became such a focal point for you, because it seemed like that really made a pretty big difference, at least early in the evolution towards a more digitally driven ecosystem.
Well, I'd like to say it's all because of a well thought out plan and our strategic wisdom, but a lot of it was luck because there was no blueprint for this, as you know. I mean, the internet comes along and it was all completely novel and new. And, companies made whatever choices they made. Again, our decisions were largely grounded in the customer experience. And if you think about it intuitively, it makes sense that however you serve a customer, that doesn't really matter. It should be a seamless thing. They get to choose how they want to engage with the business, but we should make it easy for them at all touch points. And so I think we just inherently figured out or decided early on that the best way to do it was to be channel agnostic, to your point. I think the difference is, part of that is we take a long-term view of it. As I'm thinking about this now, if you look at a lot of companies, what they did in those earlier days, it was around financial engineering. It was like, well, what if we spin off online and do a different company and an IPO, do this whole thing. That was just never part of our deal. We were just trying to make the whole thing work and work over time, and not just make a quick strike and make a buck and get out of there. That was just never the deal. So maybe that contributed to it. I don't know.
Yeah, well, it seemed like a good call. Yeah, Michael and I have talked about this a bunch on the podcast. It seems so many companies talk about being customer centric, and I think if you took that orientation, it would be pretty natural to push towards bringing things together. We'd love to get your perspectives at the risk of stating the obvious. The more, let's say, traditional department store model has been under pressure for quite a long time for a bunch of reasons. I think, most interestingly, maybe over the last little bit is competition from department stores vendors, which was something we did not pay enough attention to, I can tell you, at Neiman Marcus back in the day. But in any event, I'm just curious, as you look at the state of play in the industry, what's your take on that? And specifically, how is Nordstrom responding?
Well, it's certainly gotten more competitive, and customers have more choices, and that's great for customers, but that doesn't make it great for legacy-oriented brands or people that do things in a heritage or legacy way. You just have to keep evolving what you do. And I think our view on the department store thing, if you think of the ecosystem of the best way to reach the customer in the US, it's part of that recipe is that there's a multi-brand store that has a certain curation to it and a point of view. It used to be the only way, but now it's one of several different ways that brands can decide to bring their products to market. And so our view on it is, they probably need at least one multi-brand store if they really want to grow and scale and reach a lot of customers. We have 32 million customers. That's probably the most appealing thing I can say to a brand about why they should sell us. And we're a successful business that has consistency and longevity, and we try to be good partners. So that's really what we talk about. So, but we know that we're really in competition with other multi-brand stores because they don't need them all. And I think you've seen that result in some people go away or whatever challenges that they've had. But our focus is just being a really good partner for brands. We probably talk about that a lot more now than we did 30 years ago. I mean, as you can relate to, it was a different time.
So, Pete, does that change? What I think about is there are obviously these mega brands. If you think about the house of brands from LVMH and Kering, and some of the Chanel, some of these really big brands that have an awful lot of their own stores, and then there are some smaller brands, let's say more focused brands where maybe that wholesale partnership is really, really important. Do you make a distinction there as you think about how your strategy evolves, or are you really trying to serve, I don't want to say the widest possible market, but a wider market given where Nordstrom is positioned?
Well, we have a pretty broad market that we serve, and really the goal is just to give customers the best the world has to offer. We weren't in the true luxury and designer business in a very major way until probably 25 years ago. We started getting into it more, and it was just a result of we have customers in our store that want to buy these things. Why should we send them out the door to get it from someone else? And so layering on that business was the right thing to do. And we did learn that our customers were not only aspirational, I mean, they also were able to buy these things and wanted it. And so that was important, I think, for us. But it was all part of this idea, again, that you're locked into what customers want. You try to provide a solution for them that's complementary for the brands. I mean, again, we got to make them happy. It's, LVMH, those represent some of the best brands in the world that customers want. But as you know, the whole designer luxury thing is built on scarcity. That's how their whole strategy works. And so they're not going to sell everybody. And they have to be compelled why we are a good choice for them. And it's never been easy. I mean, you talk about being at Neiman Marcus, and we were always competing against that because they typically preferred a pure play luxury place over what we did. Except over time, what became clear is we had more customers. We had younger customers. A lot of that represented new customers for them. That was really, as has been, the leverage point that we have. So even in a place like LVMH, where they have a successful retail network for most of their big brands, they will tell you that in the U.S. market, there is a multi-brand store that's part of the recipe that they need to get the market share they want. And the time we spent with them is just trying to earn that partnership.
Pete, let's shift gears a little bit. Let's talk about financial operating issues or financial operating structure. You partnered with the Mexican retailer Liverpool last year. I think you said recently that really that's them bringing in capital more than strategic alignment. And is there any comments you'd give us to tell us how that on a day-to-day basis works? Is there operating decisions, or really is there from the outside in more an investor allowed you to go private and make the changes you needed to make?
Yeah, we vetted a lot of different possibilities and choices when going private. I think that's necessary to make sure that you're doing right by the shareholder and the business. And we looked at strategics, we looked at private equity, all the different ways that you could take a company private, because we couldn't do it on our own. We needed money, we needed partnership on that, and we're super fortunate that the guys from Liverpool came along, because that enabled us to really just take on a common equity investor, not a merger, just because they thought, we've got a successful business in Mexico. We're in the same business as you guys. We want to be able to invest money outside of Mexico in what we're doing. We want to invest in something we understand. We think, we being Liverpool, that Nordstrom represents a great opportunity. They were really nice to us and flattering, saying that they thought we're a best-in-class department store, and so they want to invest with us. And once that opportunity came along, it really kind of cleared the way for this to happen. I'm not sure we would have gone private, or even maybe could have, without that. So, on day one, we're the majority owner. They don't have the desire to be the majority owner. They don't want to run our business. They don't want to merge. We don't want to merge. I mean, I think, as you guys know, there's quite a clear history of department stores trying to work in different countries. We've had our own experience with that, and none of them have. I mean, not one. You can't point to one.
Michael's Canadian, so he might have an opinion.
Yeah, we can have some experience. Chapter we can talk about, but they know that, and we know that. So we're not. There's no agenda or obligation around what a typical merger thing, because it's not a merger. They're an investor. Now, if there's low-hanging fruit, if there's things that we can do that benefit each other, of course we would do that, because we're partners in it. But ultimately, they want it to be a successful Nordstrom business. That's what they want.
Yeah,
and
love it.
That's what we want too. So we are well aligned.
Well, it's they're a great partner. It seems for you. Pete, I wanted to talk a little bit. We haven't talked about the Rack business, which is obviously a very important part of Nordstrom overall. But I'm trying to think a little bit about how you think about your portfolio going forward. And I don't want to make this too much about the Dallas market where I happen to live, but as I've observed what's happened in Dallas for the Nordstrom company over time, you've closed, I think you just announced another full-line store closing. You've been expanding the Nordstrom Rack concept. I see you're opening a couple more Nordstrom locals. I would love to just kind of understand, as you think about not just these are physical manifestations. Obviously, you have a huge online business, but just as you think about the portfolio and how that's likely to evolve over time and kind of the interrelationship between brick and mortar and digital. How are you thinking about that?
Well, I think one of the good decisions we made a few years ago is that we would take off the governor any kind of imposed rules about the different banners that we have, the different channels that we have, and how they grow or what happens with them. Like, we view them all as part of the ecosystem, how it benefits Nordstrom in total. But a big part of that is allowing each one of these channels to go where they're going to go, because that's what customers, they're making that choice. So years ago, we thought about the Rack stores as really a subset of what happens at Nordstrom, and we only wanted to have, perhaps one Rack store for every 2 full-line stores or so. We had these ideas of how that should work, and we had a board member when we were a public company who says, "Guy, that Rack thing's pretty good business. Like, why don't you guys have more of them?" And we didn't have a very good answer for that. We're like, well, we don't want to have too many, and we don't want to have more than the Nordstrom stores. And he goes, well, why not? I mean, why don't you seek its own level? Which was really great feedback. So that's what we've done. We took the governor off that, and we're let it seek its own level. I mean, if TJ Maxx is opening 300 stores a year, and has, what do they have? Over 2,000 stores in the U.S. I mean, at that time we had like 200 Rack stores. Now I don't know that we could have 2,000. We probably can't. We have a different proposition than they do. We have a much higher average price point. But could we have 500 stores? I think so. And so let's just let that happen as it organically can. And so we spent a lot of time looking at where we've had successful Rack stores, kind of what that all looks like, the co-tenancies that we need, the type of centers that we want to be in, even the proximity to a Nordstrom store. I mean, it might seem counterintuitive, but our most successful Rack stores are near our most successful full-line stores, and in some cases right across the street, because you're just bringing more people to the party, and that works. So it doesn't once we learn it didn't cannibalize each other, we'll let it do its own thing. So, and it's similar with online. I've met with a lot of department store retailers, for example, part of the IGDS group, this international group of department stores. And some of those guys that really only have the one or two stores, they don't even do online business. And they're like, we've got to shut that online thing down. We got to figure out ways to get people in the store. I mean, it's killing us. And our thing is like, hey, man, if they want to go online, that's great. I mean, it's 40% of our business. If they want to go in a store, great. But what we've learned is that customers don't view themselves as one channel shopper, like I'm an online shopper, or I'm a store shopper, or I'm a Rack shopper. Our best customers actually engage with us all over the place. Sure. And so we've just kind of let it, again, seek its own level as long as we can take the friction out of the inner banner kind of play. So you mentioned Dallas. It's a great market. It's a growing market, so it might seem counterintuitive that we've closed a couple full-line stores there. But the other thing that's true is physical markets evolve and change. I mean, I think about when we first went to California in the late 70s, and we were in all the best malls there over the next several years. But those malls change based on how neighborhoods evolve, how the different mall landlords, like what their strategies are, what their co-tenancies are. And some of the malls that were the absolute best ones in 1979 were not the absolute best ones in 2009. So I think that's part of what we looked at Dallas. And then we've also learned, as the Rack business has grown and the online business has grown, we probably don't need the fourth and fifth store in every market. And we'd rather have fewer ones that are really good than stores that feel like maybe Nordstrom Light or something because they're the fourth or fifth best one in the market. So that's part of what that's about. But I mean, the Dallas market, we would be open to considering having more full-line stores there if there was some kind of mall development or something that lent itself to that, or if we thought that we could do something that's accretive to the total of what we're doing there and improve our footprint for customers there. But, it is what it is. We were able to add more Racks. That's been great. I mean, our North Park store is really good. It's one of our absolute best. And the Stonebriar store has been growing like crazy. So we feel really good about our footprint in Dallas right now.
Can I just, and I'll kick it back to Michael in a second, but maybe just a quick follow-on question about the role of Nordstrom Local, because one of the things that occurred to me a number of years ago, and I really loved when you guys opened your first local stores, because I had this idea even way back then that there were going to be fewer department stores that would be better, to your point, but maybe there's kind of a hub and spoke system where a smaller format, whether that's local or maybe like Bloomingdale's is doing with Bloomies, would be a way to serve as kind of an omnichannel fulfillment hub, returns, pickups, and be advertising for the brand. And even though you're opening some more locals, it hasn't actually been at a blistering pace. And I'm wondering whether you just have any kind of commentary for the role of local as maybe you do have fewer but better flagship department stores.
Well, as I think in the locals, we don't really sell anything there. I mean, it's really a services situation. So the most common services we provide there are people being able to make returns, alterations, things like that. Just the whole service part of what we do. So it's being able to bring the services closer to a customer, make it more convenient. Part of what I think limits the amount of locals we need is the rack stores work as that. So you talk about being able to return something at someplace other than the full line store. We take full line store returns at the rack. We take online store returns at the rack. So in a lot of ways, it serves as a local as well. So we have that physical footprint with racks. So the local thing's really a bit more about, you get in the bigger cities where you have these neighborhoods that are really robust in terms of the customers we have, but it's a crowded, busy city, and even driving 5-10 miles is a huge inconvenience. So you think about like New York, you think about Los Angeles, and places like that, Chicago. There are the definite neighborhoods and communities where we can drop in a local if it's kind of a target-rich environment for the amount of customers that we have. But it's really a complementary strategy to how we can make the whole ecosystem work. And so we don't have a plan about how many locals we need to have. We really look at things more by market and think about what's the best way we can serve that market.
Pete, last question for you. As I think about the last 5 years, there's been such important shocks to consumer behavior and retail structurally. We had the whole COVID era, and now we probably have another similar or even bigger shock with the way people are using AI to discover retailers and to shop. As you reflect back on the last 5 years, kind of a look backwards and a little bit ahead, did you think that any decision that you made to position the company where it is today was the right decision or the wrong decision? Do you look back and say, we could have done that a little bit differently, or are you happy with where the company is today? I think you described it recently on your talking to a lot of people about 125 as a retailer with heritage versus a heritage retailer. How do you think about those things?
That's a really good question. Well, you never have the benefit of hindsight. Like I said, there really isn't a crystal ball in this thing, and a lot of what's happening is new. So you just do the best you can in the moment. So I think when I say I don't really look at it in terms of regrets. I think we've always done the best we could in the moment for all the right reasons, but it doesn't mean everything's worked. And I think if you are willing to be vulnerable that way and honest with yourself and let, again, the customer be the guiding strategic light around how you make decisions, that, things evolve and they change. Look, if we could get a do-over again, would we do Canada? Probably not. I think Canada would have worked if not for COVID. As you know, It was rough in Canada with COVID. Stores closed like for a year, that whole kind of thing. And that's just when we were getting started. And
we also lost, and we still haven't gotten back, the entire Chinese tourist market, which was in the Vancouver store, made that store. Right.
Yep, I think that's right. It certainly helped that store a lot. Vancouver store was always good, even on our last day. That one worked, but we didn't have the scale to be able to do what we needed to do up there. You can't just make it work with one store. So that was a big investment. If I had the benefit of hindsight and knew COVID was coming along, we knew that. I do think back to that point I made earlier about all of us should follow the history a little bit closer, because no department store has really ever figured that out. And maybe it was hubris for us to think that we could do it. But it was part of a strategy of we'd grown organically with full-line stores in the U.S. about as much as we could. And we weren't at that point really pouring on the gas with the rack. So we had to think about what kind of growth vehicle we had. And we said, well, Canada could work for us. And if that really works, then maybe that creates international opportunities. But I think the lesson learned there was, at least in the foreseeable future, I don't really think that's going to be part of our playbook at all. So I don't know, that would come up maybe, but we honestly don't spend a lot of time on regrets. We want to just keep going, give ourselves a little grace, thinking that we've done the best we could in the moment.
It's great leadership lessons. And speaking of no regrets, we have no regret that it took us a few years to get you on the mic. This has been a fantastic interview. Thanks for making time for Steve and I here on the Remarkable Retail Podcast. Real treat to hear your insights. And once again, thanks for joining us.
Well, look, it's been my pleasure, and you're nice to have interest in what we're doing here. And it's it is good. I think with this 125th anniversary, gives us a chance to celebrate some of the successes we've had. But really, it's not about just being an old company with heritage. It's about how this represents a moment in time where we can look to the future and have something to work towards there. And we feel like we do. We've got good momentum. Our business has been really solid in the last year or so. We feel like we got good growth opportunities. And I think to some of the points that you guys made, there's market share opportunities if we do the job right. So we feel good about what's going on right now. It's been a fun and rewarding time here at Nordstrom.
Well, congratulations on all the success, and we both wish you much continued success in the future. So once again, thanks for joining us.
Thanks so much.
All right, we are back. A couple of things in the news. Let's talk about TikTok Shop. So we haven't talked about TikTok in a while. I guess the transfer of ownership happened. Like, it's been very quiet. There's a few other things going on.
Yeah, there are a few other things.
There's a few other things going on. But it's owned by Larry Ellison or whoever owns it. I forget now. But it looks like whatever's happening, good numbers.
Yeah, just really quickly, I saw a report that TikTok Shop's sales rose 84% between basically over the last year, between March of last year and February 2026. We don't have great data on how big the business was, but several of the reports I saw said that their estimated U.S., of course, they're in a bunch of other countries, but their estimated U.S. GMV was over $15 billion, which would be about the same size as Macy's revenues. Now, most people would know GMV and revenues are not the same. I think, but it is where consumers are flowing their dollars through. So I think at this point, the real story is the speed of the disruption and their growing influence, because obviously if they keep up anywhere near that growth rate, then, pretty soon they'll be at $25-30 billion and quite a bit more worldwide. Yeah.
Interesting. Now let's talk about the resale sector. I was reflecting on our episode when we were talking about this, supposed connection between GLP-1s and this double-digit growth in the apparel. And as I was thinking about it, that it also means there's a lot of apparel that comes used to the market that could be quite good. And I had not heard of this company, Vinted. Tell us all about it.
Well, they're actually one of the first so-called peer-to-peer or C2C platforms for fashion and lifestyle resale. So similar in many respects to ThredUp, Poshmark, The RealReal, et cetera. I think they're not as much on the radar screen in North America because they started in Lithuania, of all places, and their initial growth was in Eastern Europe, Baltic region, and then kind of across the market. So much bigger in Europe than in the U.S. and some other parts of the world, but they are expanding. And so I mentioned this for two reasons. One is it is tied to my prediction about this being a big year for resale. And I think what you mentioned about the supply side being very favorable for a bunch of reasons, but GLP-1 being, but the demand going up as well. But the really interesting thing, which I think validates the size of the opportunity here, though, of course, valuations don't always stick, as we've pointed out with Wayfair, with Allbirds, and a bunch of others. They just raised money at an $8 billion valuation. So that is pretty impressive. So again, this could be a case of people being crazy, or it could be people seeing just huge potential.
Tipping point.
Yeah.
Could be a tipping point in the resale. We've been talking about it for many, many years. It's been a niche at best, and but maybe it's another sign of a tipping point in that category, right? All right, let's wrap up. What's on your radar screen this week?
Well, I have two things, so I'll try to be quick about it. One is really tied to what we were talking about with the macroeconomic tea leaves, which is a specific statistic which I think is really worth monitoring over the next couple of months. So in the U.S., we've had 2 straight months of lower savings rates and also negative growth in real income. And part of what I've seen several economists speculate is that the way customers are solving for maintaining their spending is to dip into savings. And so part of what they're saying is that there is a lag between when people adjust to higher gas prices, and they try, they hope it's short-lived, or they just don't have any other way to solve for it. But the tendency is to first go to savings and reshuffling your spending a little bit. So anyway, the more negative view of this is that the resilience, so-called resilience we've seen in the last few months is being fueled, at least by the lower income customers, by going into savings. And that is not sustainable. So we shall see. The other one, quite different, is just coming back to the Bed Bath & Beyond story. So we talked about how Bed Bath & Beyond is really the resurrected overstock, that they bought Kirkland, they bought Container Store. Well, they are about to. My understanding is the very first test store will be opening in just a couple weeks across town in Fort Worth. The combined Container Store, Bed Bath & Beyond store. Now, there were a few things that came out this past week. One is Bed Bath & Beyond's earnings, which showed some good sales growth, but some significant losses. But they are very much a business in transition. They also announced that something like 30% of the Container Store inventory is being liquidated in order to make room for the Bed Bath & Beyond, Kirkland, and they've got another company that's in flooring or cabinetry or something, product being added, which makes sense. I mean, now I do think that Container Stores, for people in North America that would be familiar with them, they're not especially large stores, but I would say they're a bit over assorted. So I can imagine ways to tighten that up
sure.
without it being tremendous degradation to the shopping experience. But I'm having a hard time. I keep referring to it as a dog's breakfast, which some people know that saying, of trying to understand how they're going to have Kirkland product, Bed Bath & Beyond product, and this cabinetry flooring stuff all in I think those stores are 16 to 20,000 square feet. So, I mean, that's, a third of the size of a typical old Bed Bath & Beyond, which didn't have a lot of the Container Store. So it will be interesting to see. And obviously the entity itself is really pushing for this very hybrid strategy of significant online presence with with Kirkland and Container Stores, several hundred stores. So it's not a teeny business at all. So whether they can resurrect this thing powerfully, time will tell. But I'm going to be interested to see it. I just can't visualize how it's going to work.
On my radar screen, and I guess probably fueled by the fact that I'm sitting at a global trade show in the food business, is global trade. So, we've got a review of the trade agreement, the North American trade agreement between the U.S., Canada, and Mexico coming up. It's not the end of the agreement. Now, the agreement was signed by President Trump, and he hailed the agreement as a colossal victory and the largest, fairest, and most advanced trade deal ever reached. That seems not to be the narrative today. And there's a review of
That's so weird, because he's rarely prone to hyperbole.
It's we look at that and we say, what could go wrong? Anyway, we're looking to this review that's coming up, and there's a midterm review. The actual agreement doesn't expire until 2036, I think. So this is a mid-review. So on the radar screen is how those negotiations, whatever they're going to look like, are going to happen. And what I'm hearing here, how I'm going to anchor all this, I've done a number of interviews of brands here looking to grow, whether it's in the States. A lot of people talking about looking for growth in Mexico. A lot of people talking about India. And the general through line is reliability. We want reliable partners, right? And, up, down, or sideways, agreements here, agreements there. It's reliability. Like, these people are mid-sized. They can't build a business on the back and forth sudden gyrations, and they look for reliable partners. So we'll see how this trade agreement between our three nations sorts out. Right now, Mexico is the biggest trading partner, surpassed Canada as the biggest trading partner, partially because of some repatriation of some automotive. But with the price of oil per barrel, I'm projecting that Canada actually gets our spot back because of the the higher price of oil and the global price trading. We're all watching that, and I think it's very important to U.S. businesses, U.S. retailers across North America. So that's what's on my radar screen today. And that's a wrap on this episode, our 300th episode. So once again, thank you to all the listeners for tuning in, and lots more great stuff to come. And thank you, my friend, for being my partner in this. And we'll look forward to doing, something like 300, 300 more.
Let's see if we get to 400 first. Thanks for tuning in. To help more retail leaders discover the industry's leading podcast, please drop us that 5-star rating and review on Apple, Spotify, YouTube, or wherever you enjoy your pods. And for more on my strategic advisory services, keynote speaking, best-selling books, and even more retail industry insights, go to stephenpdennis.com.
If you are a brand or service provider looking to take your influence to the next level, reach out to us for sponsorship, advertising, or event partnerships. And if you want to learn more about my own keynote speaking and advisory practice, reach out to me via LinkedIn.